Saturday, November 19th, 2016, Monaco 64, home of alternative economics and contrarian views. I like to talk about the U.S. Treasury market or U.S. bond market, government bond market, and interest rates. There's been a lot of talk in the financial press about yields in Treasury spiking higher. And that means that Treasury prices are dropping, because in bonds, when yields go up, prices go down. So first of all, I like to say that I've made quite a few videos in the last 12 months about the bond market, and I'll put them up in the information above on this video so you can have a look at it. First of all, today I'm going to start with talking about long-term, direction of the U.S. 10-year yield, because that's the benchmark interest rates for the U.S. So I've got a chart here going back to 1790 of the 10-year yield, U.S. 10-year yield, and as you can see, after the end of World War II in 1945, those yields hit around 1.45%, and they went up almost to 16% back in 1981. So that was the topping yield. That was a bottom in the bond market prices. And ever since 1981, up until July this year, bond yields have been dropping, zigzagging, of course, up and down, but the trend has been definitely down, and we reached a low of around 135, so below the 1945-1946 low there. We reached that low in the beginning of July this year, 1.35%. And so another thing I wanted to talk about is the U.S. national debt. Because in 1981, when Reagan took office, the U.S. national debt was just under $1 trillion. I think it was 982 billion, so virtually $1 trillion. And so I've got now a chart, a bar chart of the U.S. official national debt for the last 45 years. And you can see how since the early 80s it's been rising and rising and rising. It accelerated, like you can see, from the year 2000. And this acceleration in the debt corresponds to the that previous chart I showed you, where yields have been going down because it's easier to borrow when interest rates go down, so you indebt yourself more when you can borrow more and more cheaply. So you can see the U.S. national debt is now about 20 trillion, and it's not surprising that interest rates have been going down. But the problem with that now is that just like when you put money in a bank and you're able to get 5%, which you can't anymore, I know, but in the past you could, and you can compound that. The compounding really helps you grow your wealth. But on the other side of the coin is if you've got debt and the interest starts rising, that debt starts, the debt servicing starts rising, and then you have to borrow more to pay off the interest, and it becomes the same way as the other side of the coin of rising interest rates. In a situation where you have a lot of debt, can become very, very bad situation. As we've seen in the last 35 years, it's been smooth sailing because interest rates have always been going down. And we've seen interest rates go up in the last 35 years, short term, and then come back down and make new lows. But I want to show you a couple of charts now from more shorter term view. First of all, this is from CNBC, so I've got a chart of the 10-year yield going back 5 years, and you can see how we've spiked up since the July low below 1.5%. we're now, at 2.35%. And look at, compared to the last 5 years, we haven't really seen such a sharp spike as this one. And so the key level that I've spoken about in the 10-year yield is going to be 2.5%, which you can see was the high last year in 2015. And then just above 3%, that's going to be 3.02. That was the high in the end of 2013, beginning of 2014 there. If we break that 3% level, we really need people, the U.S. Treasury and U.S. government really needs to start worrying about the situation. And you might say, oh, we're still far away, but don't forget, we've gone from a low of 1.35 in July this year to now 2.35, a 1%, increase. So we're only 65 basis points away from 3%. And so that's the 10-year. So the other chart I want to show you now is the 30-year. It's the same kind of story. The 30-year bond yield, we're above 3% there, as you can see, and the key level is going to be around 4%, which is roughly the high there in the beginning of January 2014. So that has gone from around 2.1 in July to now 3.03. So that's the 30-year bond. But the market follows both 10s and 30s, but 10s are more of a benchmark. And the other thing I wanted to talk about as well is that Zero Hedge. They come out with this story about how the liquidity in the bond market is really dropped. And what that means is that, and I've got the story here for you, U.S. bond market liquidity collapses. It's worse than Brexit. And what does that mean? Well, that means because I worked in the bond markets for 20 years in futures, and I did some cash bonds as well for institutional investors. And people come, big institutions come, will sell me 100 million 5 years, nominal amount, 100 million 5 years, or, sell 1,000 futures. Those are fairly big orders. And usually when the market is liquid, there's no problem in getting rid of the position, or selling or buying the position. But now, according to this story, small orders are starting to move the market price quite a bit. So that's a sign of instability in the market, that liquidity has collapsed in the bond market. We'll have to wait and see, but that doesn't help either. So the other thing I wanted to talk about, why is it important that we look at the bond market? Well, the U.S. has 20 trillion in debt, and I've taken information from Securities and Investments, SIFMA, and I'll tell you who they are exactly. Basically, they publish data from the U.S. Treasury and Reuters. So I've got here, as you can see, I've looked through the numbers, U.S. Treasury issuance, gross and net, and I've looked at how much the U.S. Treasury has issued. For example, in 2015, the U.S. Treasury issued 7 trillion 16.5 billion in new issues. This year in 2016, up to October, the U.S. Treasury has issued 6.87 trillion of new issues, and at this rate, they will have issued about just over 8 trillion this year. The reason, of course, they don't need to issue 20 trillion every year is because of different maturities, and they have the maturity of treasury debt is spread out, so you don't they don't have to new issues don't come up all together, all the 20 trillion. So the other thing I've looked at is the average maturity of total outstanding Treasury marketable securities, or basically the average maturity of US debt that they have to issue. You can see right now it's at 68.81 months, which is roughly 5.7 years. So, and the reason I'm talking about that is that, interest rates start rising, and we break through that 3%, for example, in the 10-year, the cost of borrowing for the U.S. Treasury is going to rise. And, when they issue new notes or bonds, they're going to be paying more, and it could snowball. So looking at the Treasury market, I've got here this list of Treasury yields from Bloomberg. You can see U.S. 5-year is 1.8%, which is still historically very low. I remember when a 5% yield was normal in the 5-year back in the late 80s, early 2000s. But in the last month, it's up 57 basis points, which is basically 0.57%. So let's say, the U.S. Treasury has to issue, 8 trillion of debt every year to finance its operations, and the average maturity is, 5.7 years. So, already now in the last month, half a percent of 8 trillion, that's 40 billion of extra interest that they're gonna have to pay, when they issue debt. So and that's only in a month, that 5 years going up by 0.5%. So if it goes up by 1%, that's 80 billion extra in interest that they have to pay. 2% is 160 billion, 3%, 240 billion. So you get the idea. And the more interest, the U.S. Treasury has to pay, the more they're going to have to issue, because they're not running, if the U.S. Treasury is running surpluses, they would be able to pay off the maturing debt with their surplus, but they're not. So if interest rates go up, they're going to have to keep issuing more debt to pay off, the debt that comes up for redemption. So that's why it's so important to look at U.S. Treasury yields and the bond market. It's the market as well that is the base for the whole financial system. So yeah, we ended up at quite at the highest yields for the year this week. The 10-year at 235, the 30-year at 302. And yeah, it's going to be very interesting. It's still a lot of uncertainty as to what the new administration is going to do. But all the signals are that the new Trump administration is looking to borrow even more money and to do public, fiscal spending. And the fact that the bond market is getting spooked as it is not a good signal. And the derivatives as well, there's hundreds of trillions, if not a quadrillion of notional derivative, contracts out there. And they're held by the biggest, the too big to fail banks, the big U.S. investment banks, the big European banks. And about the majority of derivatives are based on interest rates. They're interest rates derivatives. So if the interest rate market, the Treasury market, is is under pressure, if yields are spiking higher, all hell could break loose. We'll have to wait and see though. And I'll put, the links or, the previous videos in the information. You can have a look at it. And I've done quite a bit of videos explaining, the mechanics of the bond market. So I hope that this has helped clarify why, interest rates are so important. And it's going to spill over to the whole economy, because if the cost of borrowing for the US government is going up, you can bet that the cost of borrowing for everyone else will go up. So, yeah, I hope you enjoyed this video. I hope it wasn't too complicated. Try to make it, clear with the charts. And I just want to give people, the numbers and the facts about, the bond market and why it's so important. So if you enjoyed this video, give me a thumbs up below. Share it far and wide. If you haven't subscribed to my channel yet, please do. And if you'd like to donate a little bit to the channel, there's some links below in the description. Thanks for watching. I'll talk to you later. Bye.